Welcome back, guys. Today we're going to analyze AT&T. Now, AT&T is a competitor to Verizon, which we did yesterday, so make sure to check out that video. I'm going to determine which of these businesses is actually better or a better value. So here we're looking at AT&T. They are down 27%, pretty much the same type of performance as Verizon. Definitely didn't do very well compared to the S&P. They are a $120 billion company compared to Verizon, I think was 140 billion. Yeah, so just slightly smaller. Yeah, major competitor. Price to earnings ratio of 9, which is better than Verizon. Verizon was at like 14. Although Verizon did have some more impairment charges last year, so um, Verizon could have been pretty close to 9 as well. Uh, let's take a closer look at the financials. In terms of their revenue, their revenues dropped down to 122 billion. They actually sold off parts of their business, and that's why their revenues dropped so much. But I would expect moving forward that their revenues are going to be pretty steady at about 122, and they might grow by 1 or 2% a year. Of after that, their revenues just dropped because they sold part of their business, and they had to take massive write-downs on their assets, and that's why they had some massive losses in these 2 years, 2020 and 2022. Um, Otherwise, last year they didn't do too bad. They had 20 billion in pre-tax income, and then after taxes, it was almost 15 billion, 14 and a half. And then they've been diluting some shareholders as well. They do have a lot of debt, so they have to pay that off. Yeah, in terms of their debt, they have 151 billion in net debt. Um, At least they brought that down from 180 billion, but yeah, still not very good, especially when their market cap is 120 billion. Uh, the net debt is really high, so we'll have to take that into account. Um, that is proportionally higher than Verizon, just a little bit. In terms of cash flow, though, their cash flow is really, really solid, and they pay 8 billion in dividends. So they had 20 billion in free cash flow, and they paid 8 billion of that in dividends. They do a little bit of share buybacks, and it looks like in 2021 they actually chopped their dividend basically in half. So that could be the reason why the stock has been punished so heavily. Let's check out their stats and see what their margins are looking like. In terms of their gross margin, it is getting back up to like 42, 43%. That's right around where Verizon is. And their operating margin around 20% and translating into the net margin. They've had some years where they were negative, but I think last year is the best representation of what they'll do in the future. That was around 12%, and the analysts are expecting 13% moving forward. So I think we'll use 13% in the analysis, and Verizon's was 14%. Um, what are the analysts saying? Well, 20 or 2.2 in terms of earnings per share, going up to 2.29, and 122 billion going up to 124. They're expecting a 1.2% increase in revenue into 2025. Let's check out their short percentage. They are shorted at 1.15%, which is a little bit higher than Verizon, but still, this is a green flag. It's not very high. Let's look at the spreadsheet. This is a valuation model that I created. I put the earnings estimate here, revenue estimate here, buybacks of 200 million, net debt of 146 billion, discount rate of 10% because I want a 10% return on all my stocks, and an exit multiple of 15. That's what I put the exit multiple for Verizon at, so that we can get a good comparison here. And yeah, 15 I think is fair for businesses like this. It needs to be pretty low because it is competitive and they do have a lot of debt and it's low growth. So yeah, those are pretty much all the negatives that you have to watch out for. And that's personally why I don't really like the telecommunications areas. But yeah, 2% growth, just keeping up with inflation in terms of their earnings. And I did the same thing with the revenue. And in this case, then we're looking at a fair share price of around $30 a share. But when you account for the debts, then it drops all the way down to $10 a share. Of course, with how consistent this business is, I put their fair share price somewhere in between these two. I'd probably say around $20 a share, which is slightly higher than the current price. And even with the revenue one, with 13% margins, it's about the same. About $20 a share, I'd put them for a fair share price. And so, yeah, I would probably buy AT&T over Verizon. Verizon's fair values were a little bit lower in compared to their current price. So I would take AT&T over Verizon, and that is my conclusion. Let me know in the comments what you guys think. Let me know if I missed something, because maybe Verizon has something that AT&T doesn't. But yeah, these, as far as I know, they're pretty similar to each other. So yeah, make sure to hit that like button, and I'll see you in the next video. Peace.